Interest rates are going to rise. People are freaking out. Maybe it's you that house prices will crumble, will crash. In this video, I'll be taking you through two charts to illustrate that that may not actually be the case. Okay, there's actually more to it than just a linear relationship between house prices and interest rates. I'm not here to sell you anything. You make your own conclusions, but here's what the data says. So at least do yourself a favor and understand what the historic relationship has been. If you're interested, carry on watching. This is the first chart right here. And by the way, smash the subscribe button, guys. You know, this is hopefully going to bring you a whole bunch of value. What you're seeing right here, this is from ANZ Research, is the aqua or the green line is on the right hand side, the axis. It's the cash rate, the official cash rate, but not in absolute terms. It's percentage or percentage point change. Okay, so anything up here is a percentage point change downwards. In other words, cash rate is dropping. And anything down here is where the cash rate is increasing. Okay, so it's inverse. And then on the left hand side, or the darker line, that's house price change year on year. Okay, so let's go through these cycles. So the first one here, shaded right here, is where in the mid-90s, interest rates, you can see they went up. Okay, I know it goes downwards, but that suggests that interest rates went up. You can see the axis is inverted. Okay, here interest rates went up, as you can see by this light green line, and house prices, the percentage improvement or growth in house prices, that came down. All right, you can see interest rates went up a lot. House prices on average nationally didn't drop more than 4%. Okay, 4%. Okay, next one. Here, on this period, interest rates have also steadily gone up. Okay, from this point to this point. In this time, house prices have actually gone up. So there wasn't a direct relationship between interest rates going up, going this way, remember the axis is inverted, and house prices. Okay, there wasn't the same relationship as back here in the mid-90s. Okay, then you have this period here, 2003, 2004, where interest rates were pretty much flat and house prices came down a lot. They didn't actually drop in value. It's just the rate of growth reduced from 16% down to 0%. Okay, and then over here, you got interest rates going this way. In other words, going down. Remember, the axis is inverted once again. Interest rates, the change was negative. They went down and house prices went up. Okay, go figure. That makes sense, as they did here again. But then look at this. Here, interest rates in 2017-18, they didn't really do much. They were pretty flat, but house prices came down, and that's because of APRA. They tightened the ability of banks to give loans to investors. And then most recently, interest rates have gone down. You can see negative, negative, negative. They've gone down, down, down. COVID, obviously. And you can see that house prices have shot up. Okay, and obviously the prediction, it kind of goes without saying, right, is for interest rates to increase. You can see here the cash flow forecast from ANZ is to go up. You can see from 0 to 1, this is percentage point change. It's not percentage, it's percentage point change. So this is 100 basis points. Okay, and so when that's happened previously, for example, here, house prices have gone down 4%. When that's happened here, house prices have gone down as much as 7% in the GFC. When that's happened here, in the turn of the century, house prices went up. And when it happened here, house prices came down by 4%. So it's not that every time interest rates go up, that house prices can't come down. As you can see here at the turn of the century, 2001, 2002, it was the opposite relationship, but mostly they do come down, okay? And let's be real about that, but how much do they come down? Okay, here they came down almost 4%, here 7%, here 4%, here not because of interest rates, they went down, but that was a different reason. So is a 4% correction in the housing market really reflective of a crash? No, it's not. Okay, I just want you to understand, and I know everyone's saying wage growth, everyone's saying debt, everyone is saying all sorts of things, right? But the reality is that each of these previous instances where interest rates went back up, they also had their unique situations. We were always a debt-laden country. We were always, experiencing a lack of wage growth. In fact, productivity has been so poor in the labor force here in Australia in the last 10, 15 years. Wage growth has been negligent, real wage growth, that is to say. Okay, so almost since the start of the century, basically, maybe not the start of the century, post-Howard, wage growth has been almost non-existent in real terms. Okay, so I just want you to understand, digest that, and when this says that house prices have come down 4% or 7% or 4% here, that is national. And remember, what skews national numbers is Sydney and Melbourne, because that's where the majority of people live. That's where the majority of houses are bought and sold. But that's hides or masks the fact that even during this time, there were markets around Australia, other cities, other regional areas that were actually rising, or at least not dropping. Okay, so this whole thing like house prices will crash, that's simply not true across the board, okay? That's the first point. The second chart that, with your permission, I want to show you here is right here, okay? So this is a table, stick with me, for those of you who truly care about your financial future. So what you're seeing here is 4 different time periods, 1994, 1999, 2002, 2009. And this is talking about interest rate hiking cycles, okay? So hiking cycles 6 months after last hike and 12 months after last hike. So it's giving you an understanding of when there's a cycle of interest rates rising, what happens to the property price, over that 6 to 12 month period. Does it crash? Are we going to see a crash in 2023 or are we not? Okay, so 1994, the cash rate before the hikes was 4.75%. Cash rate after the hike was 7.5%. So huge rise, right? Almost like 100% rise in the official cash rate, in fact, 2.75 percent. This rose very quickly, 6 months. Everyone's saying, these interest rates are going to rise so quickly, PK, market's going to, be just completely destroyed. We've had this happen before. House price change in the next 6 months was just negative 2.7, okay? And the house price change after 12 months was 2.3. In other words, house prices are pretty flat. And I can tell you there were markets within markets that continued rising. All right, I wasn't investing in 1994, so this is just based on the data. 1999, cash rate before hike, once again, 4.75%. Cash rate after hike, in that cycle of hike, 6.25%. That took 10 months, okay? So it was a more gradual and shallower hike than in 1994. House prices after 6 months, actually up 5.9%, and after 12 months, up 15%. Okay, so here interest rates went up, house prices went down a bit. Here interest rates went up almost by the same amount, not quite, and house price actually went up. So the logical person or the logician would say there are more factors at play that dictate house price than just interest rates. Okay, than just interest rates. I mean, just don't get me wrong, they almost doubled here, right? It's pretty significant. If you're paying $15,000 per annum in interest, you were paying almost double that, okay, in the year's time. But house prices stayed solid. 2002, start of the rate cycle was 4.25, and it went up to 7.25. This took, a long time, so it was very, very shallow. And therefore, as expected, in the 6 months, well, not as expected actually, in 6 months after that, house prices went up 52%. And 12 months after the last hike, so in other words, after 5 years, they went up basically 50%. So this was a very shallow and extended interest rate rise cycle. And even despite that whole cycle where gradually interest rates were rising, property prices were rising too over that 5-year period. And then after the GFC, we started off at a cash rate of 3, went up to 4.75, so not a huge rise, took about a year to happen. House prices were pretty flat. Okay, so why am I sharing this? It's just to say that there is more that meets the eye than just saying interest rates will rise, therefore house prices will fall. And I know that everyone will say that, well, PK, this time it's different. This time it's different. Debt is high. You know, we're starting off a lower base. Everyone has overextended themselves. I've done so many videos on this addressing these different topics. I'll put them up here and I'll also add them as cards at the end of this video so you can, go watch that next. But that is what they always said. Every rate cycle, the pundits, the experts, even bank economists, the naysayers, everyone said house prices are going to collapse. This time it's different. This time, do you remember in the GFC, everyone said this time it's different. Yet house prices in Australia didn't fall more than 8%. And that was led by Sydney, Melbourne. Now, don't get me wrong. I'm not saying that you can put a blindfold on and buy in Sydney or Melbourne. In fact, that's not financial advice, but that's what I'm really recommending against. All right. But what I'm saying is there are areas in Australia, Perth, regional Queensland, regional New South Wales, places like Wagga, places in the south of Perth, on the north of Perth, places like Toowoomba, up far north Queensland, Townsville, where even if interest rates rose 2%, 3%, maybe even 4%, people don't need to sell their houses because affordability is so high. Incomes versus mortgage repayments are so solid. Okay, so it all comes down to markets within markets. The question is not, is this the right time to buy? Should I wait until the house prices come down and then get in? That is not the question. The question is, if I'm ready to buy, I should buy, but where should I buy? Okay, where should I buy? Every city, every suburb within a city are different in their economics. That is true insight, and that is something that a 500-word media article cannot tell you. In fact, I've not even done it justice. I'll tell you, this was an imperfect presentation. It would require a decent 2-3 hours to really go through all the factors. Maybe you want that. So leave a yes below, in which case I have to do a thesis. But hopefully that gets you at least your mind thinking. At the end of this video, I'll leave a few cards or video links for you where I've talked about these things more, and you can get a more all-rounded understanding for yourself. But at least do me a favor and get out of your system that interest rate rises automatically relate or equate to house price falls. Hit the subscribe button, turn notification bell on. My name's PK. Do the right thing. All right, catch you later, guys. Bye.